Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. Today we're going to look at a common trading strategy called arbitrage. Although it is usually associated with a short-term trading rather than long-term investing, the concept plays an important role in how markets work. So there is overlap with quantitative approaches. Before we start, I want to mention that the channel now has a Patreon page. There you can download the finished code for a historical pricing dashboard we built in a past episode, along with an expanding PDF that collects the materials covered on the channel. It is designed as a reference, especially if you prefer reading or want something to revisit later. If you've ever noticed different prices for the same item at different grocery stores, you are already halfway to understanding arbitrage. Arbitrage has to do, first and foremost, with a price discrepancy for the same item in different markets. Grocery stores aren't perfect analogs for financial markets because they don't usually buy items from you, but imagine they did. Suppose you discover a price discrepancy for a gallon of milk. You could buy it where it's cheaper and then sell it where it's more expensive, making a profit, and that would be your first arbitrage. You might think that once you discover a price difference in two markets, you are guaranteed a profit, but you still need to buy and sell your asset, or carton of milk, in a timely fashion. In the grocery store example, the stores could be far away and the milk could spoil. More realistically, you are not guaranteed that prices will hold. If the price drops while you're trying to sell, you can lose money. This is called execution risk, and it's the main type of risk in traditional arbitrage. But execution risk isn't the only concern. In real financial markets, transaction fees, bid-ask spreads, slippage, and even transfer costs between exchanges can completely eliminate what looks like a profitable opportunity. A related concept you should be aware of is the law of one price, which states, identical goods or assets must sell for the same price in different markets when prices are expressed in a common currency. This law describes the result of arbitrage. Imagine multiple grocery stores on the same street selling the same gallon of milk at different prices. Milk traders looking for arbitrage opportunities would buy from the cheaper stores and sell to the more expensive ones until no profit remains. At the same time, shop owners would realize they are either giving away money by underpricing or losing customers by overpricing. Very quickly, prices converge and an equilibrium is reached. In financial markets, this convergence can happen in milliseconds. Arbitrage traders provide a service to the market by keeping prices aligned across exchanges, while trying to make a profit in the process. To reduce risk, arbitrage traders try to minimize the times between buying on one exchange and selling on the other. This leads to automated trading systems where both transactions are executed almost simultaneously via algorithms. Before moving into specifics, let's revisit the formal definition of arbitrage, which should make more sense now. Arbitrage is the simultaneous purchase and sale of the same asset in different markets in order to profit from a price discrepancy. In its pure form, the profit is locked in at the moment the trades are executed and does not depend on future price movements. In reality, pure arbitrage is rare. Most real-world arbitrage involves small risks, frictions, or assumptions. So let's say you want to become an arbitrage trader. What do you need to do? For starters, you will need various accounts with funds on various exchanges or brokers and a target asset. Then you would have to monitor both exchanges and the price of assets to find arbitrage opportunities which you will execute once found. Sounds simple, but in practice it is nothing but. The first problem is speed. If you try placing orders manually, prices can move in the seconds it takes you to react. The solution is automation. But that introduces another challenge. Your systems must be accurate, reliable, and faster than the competition. Which brings us to the second problem. It might surprise you, but many people are trying to make money using arbitrage. As a result, prices are usually in near instant equilibrium across exchanges, and any differences tend to be extremely small. One partial solution is increasing trade volume, so that small price differences translate into meaningful profits. The caveat here is obvious. If something goes wrong, you can lose a large amount of capital in pursuit of a relatively small gain. There's also capital efficiency to consider. Funds must often be pre-positioned across exchanges. Capital can get tied up, transfers can take time, and in some cases, there's counterparty or settlement risk, meaning you're exposed to the possibility that one side of the transaction fails. This naturally leads to a situation where highly technical and well-funded firms are better positioned to compete in arbitrage. I won't stop you if you decide to become an arbitrage trader, but I hope you understand the challenges. Suppose a company's stock is listed on two exchanges. If it trades at $100 on exchange A and 120 cents on exchange B, an arbitrage can buy on A and sell on B. If enough traders do this, buying pressure pushes the cheap exchange up, selling pressure pushes the expensive exchange down, and the price difference disappears. This constant pressure is one reason the same stocks tend to trade at nearly identical prices across venues, even though they are technically separate markets. Once you understand traditional arbitrage, we can briefly touch on more quant-focused variations grouped under the term statistical arbitrage, or stat-arb. In essence, these strategies replace immediate certainty with statistical expectation. Traditional arbitrage relies on current price discrepancies. Statistical arbitrage models relationships between assets and predicts that deviations from historical patterns will revert over time. Think in terms of days or months rather than milliseconds. Returning to our example, suppose milk prices are historically stable relatively to egg prices. This week, milk is unusually expensive compared to eggs. You might conclude the relationship is temporary, and so you sell milk, you buy eggs, and wait for the spread to normalize. Unlike pure arbitrage, profit here is not locked in. It depends on probabilities, models, and assumptions. These strategies require statistical modeling, backtesting, and rigorous risk management, topics we haven't covered yet. They also introduce more complex risk, which I hope to explore in a future episode. For now, you should have a solid understanding of arbitrage. We also touch on one of the key reasons markets are considered efficient. Arbitrage forces prices towards equilibrium. Traders act almost like price enforcers, aligning markets through competition and speed. Arbitrage may sound like easy money, buy low, sell high at the same time. But in practice, it is a highly competitive, infrastructure-heavy activity that leaves very little room for error. Thanks for watching, and if you want more quantitative content, please consider subscribing to Quant Matters.